what I always think about is the opportunity cost.
Mm-hmm.
Because for folks that decide not to do anything, I'm going to stuff cash under my mattress.
Mm-hmm.
You are losing by not participating.
Mm-hmm.
Like, that's something I try to get to the folks that are so risk averse, is like, if you don't participate, you are taking more risk than you realize.
Mm-hmm.
And you will outlive your money, or you will have you won't have the life that you want in retirement.
Mm-hmm.
Like, those are things that matter to these people, and to get them over the hump of like, not taking risk is also risky.
Hi everyone, I'm Lauren Fisher.
And I'm Dave Fisher. We're a husband and wife team of certified financial planners, and together we make up Team Fisher Financial. Welcome to our new series we're calling And Money.
As both a concept and an object, money is a prevalent component of our world and intersects with so many areas of our lives.
By the nature of our job as CFPs, our days are filled with constant conversations around money. Conversations we think are vital for people to consider and understand for their financial universe and beyond.
Well, hello everyone, and welcome to a new episode of our And Money series. My name is Lauren Fisher, and to my right is my husband, Dave Fisher. We are both certified financial planners, and we work together as a husband and wife couple, making up Team Fisher Financial.
Mm-hmm.
For those of you who may not be familiar with the podcast, we have decided to create a series that talks about how money intersects with all of the different areas of our lives. We talked about conversations and money, just
Mm-hmm.
what it looks like to talk about money in general, emotions, knowledge. And now today we're going to talk about risk.
Very timely topic.
Risk and money. Yes, we're planning on doing this later.
Yeah.
As we were recording these, but we decided to move it up because this has been a particularly volatile market.
A lot of risky business out there right now.
Yes, which people have not been used to in the past 10 plus years, aside from COVID, which was a little bit of an anomaly.
Sure.
But we have seen a market correction in the first few months of the year.
Yeah.
We have seen a lot of uncertainty from Washington, from the current administration. And we are actually filming this pretty soon after they just announced, US and China just announced the 90-day pause on tariffs.
Yeah.
So once again, we've seen a decision from the White House have significant impact on markets.
Yeah, S&P went up over 3% yesterday.
Mm-hmm.
Yeah.
And it's up, where is it today? It's up about 70 bips.
Yeah.
Early-ish in the morning.
Very technical.
0.7%.
There you go.
Yeah. So with that, we wanted to talk about risk. It's something people talk about, risk tolerance and what that should mean for people.
Yeah.
But if you really sit down, a lot of times, even with seasoned investors, people who say like, hey, I've actually been managing this on my own. They couldn't, at least a lot of people can't really communicate what risk tolerance is, what risk tolerance even means.
Yeah.
So how should we even define risk just in general?
Well, I feel like risk is the potential for loss.
Mm-hmm.
And most people underestimate what that loss could be. Or they're just not aware of what actual risk is.
Mm-hmm.
Right. So that's part of it. It's the known. You may take known risk,
yes.
Right? People that start a business, it's a known risk,
Mm-hmm.
but then there's unknowns, expenses that come out of nowhere, bills that pile up, different things happen. And we have to be mindful that there's known and unknown risks that we have to be aware of. And
not just knowing what the quantifiable risk is itself.
Yeah.
But for a lot of people, it is understanding how you are going to respond if and when that loss does come.
Yes.
And that's hard. That's hard. That's a lot harder to predict than maybe this is what my portfolio allocation is. This is the dollar risk that I am taking on.
Yes.
Versus the market just went into a 20% correction. I am experiencing this loss. How do I feel?
How do I feel right now? What is my gut saying?
Probably
get out right now.
Sell. This is terrible. Okay, that actually reminds me. Okay, I took a screenshot on April 4th of this Reddit post. And at the time, so this was, and when I took the screenshot, like they had posted it towards the end of the day of that market day. April 4th was the day that the S&P was down somewhere around 5.8% on the day.
Wow.
And so this is, and the tag on it is crystal ball post.
Okay, so they know something we don't.
They knew on April 4th. Here we go. This isn't a dip. It's not a correction. It's the slow, brutal unraveling of a debt-soaked fantasy we've been pretending was sustainable since 2008. Not entirely wrong. The Fed is cornered. The only soft landing is for billionaires with parachutes made of your 401k. Oof. And he or she, I don't know, keeps going and ends with, this isn't a crash. It's controlled demolition with nobody at the controls. Sell, don't look back, and maybe plant a garden. We had a good run. Goodbye, and may whatever comes next be merciful. That was in the stocks like subreddit. And the reason I screenshotted it, the reason I saved it is because I was like, listen, I totally understand where this person is coming from in terms of the market was down. There was so much uncertainty.
Yeah.
And we're not out of the woods. We don't know what's going to happen with all of these tariffs. You know, the
economy is starting to slow too. It's not just tariffs. It's it's slowing from its higher, peak. It was moving a lot better.
We've had our first GDP print negative.
A lot of it because of imports ahead of the tariffs.
Exactly. So there's a lot going on. So not to say, we're laughing at this because it's very hyperbolic. You can tell it was very much driven by fear and clearly anger. Both of which at the time were understandable. But that was April 4th. 5 days later, April 9th, was the day that Trump changed course and the market went up over 9%. It was like 9.2 something, almost 9.3%.
During the day, it was up over 10%. Yeah.
It gave back a little bit towards the end of the day. So, and this is not uncommon. And it's why I saved it, because I knew markets go down. There are market corrections. In our last client video, we actually talked about this for our current clients. Just thinking about people our parents' age who, maybe weren't investing through this entire time, but were alive through the crash of 87.
Yeah.
The dot-com bubble bursting, the Great Recession, COVID, all of which were major downturns, significant corrections. The dot-com bubble crash took 3 years, 2.5 years to recover.
It's a long time.
That's a really long time. But if anyone alive today was given the opportunity to buy into the market in like 1986 at those prices, I don't think anybody would refuse that opportunity.
Like, okay, I'll lose some next year, but I'm buying in, and it's going to be how many times multiple?
Yeah, I didn't look at that beforehand. We'd have to look at it. But so market corrections happen.
Yeah.
And recoveries happen.
Yes.
How long they take, what they look like, doesn't always look the same.
Right.
But when we talk about risk, that's the biggest issue. That's the biggest concern for people is recessions are going to happen.
Yes.
Market cycles are going to happen. It's not just going to be bull market.
We've all been in traffic. How does traffic get caused? One person goes a little bit slower at the front, and then all of a sudden, an hour later, you're in bumper to bumper traffic. In the same way, human nature results, like these things happen because of human nature. Yeah. Well, something that's very interesting to me when it comes to risk is a story that many people in the finance world know. There's a book that was written called The Reminiscences of a Stock Operator.
Oh, that's a classic.
It's like 1923 or 26, somewhere around there.
Yep.
Very old book, but
Still in print.
So many people read it. It's about a trader, Jesse Livermore.
Mm-hmm.
This trader started in these bucket shops, and he was a quotation boy.
For people who aren't like
Oh.
market historians, what was a bucket shop?
So a bucket shop was a place that people did buying and selling of stocks, but it wasn't legally sanctioned. So
well, it was at first.
Yes.
In like the late 1800s, because regulation is always reactive. Regulation is always catching up to what people are doing. Mm-hmm. So like late 1800s, it was legal. Soon became illegal because it was basically a gambling parlor.
Yeah, for trading.
For stocks, yes.
Yeah. So he was a quotation board boy, mm-hmm. and he wrote down the prices of these different stocks or commodities, whatever they were trading at that time. Mm-hmm. And he got so good at understanding price movements that he actually made a lot of money. Mm-hmm. So at the ripe old age of 21, he had $25,000 to his name, which was like, I think it was like $700,000.
Yeah, because that was back in the 20s.
It was mm-hmm. a ton of money, mm-hmm. right? And he's like, hey, I'm doing great. Let's keep this thing going. Well, in an illegal, bucket shop, people caught on and didn't like that he was winning all the time, right? Like there are a bunch of gamblers here. They don't like that. So they kicked him out.
It's kind of like they were all gambling, mm-hmm. and he was counting cards.
Yes.
Yeah.
And nobody could kick him. Well, they did kick him out. Mm-hmm. They said, hey, you can't gamble with us anymore.
Mm-hmm. You can't sit with us.
So he's like, I'm going to take this show on the road. Mm-hmm. He went to New York. He's like, I'm going to Wall Street. I'm going to figure this out.
That's where the money is.
And abruptly lost all of his money.
Mm-hmm.
It was tragic, really.
Yeah.
But what he didn't understand was how to get out at the price action that he wanted. Mm-hmm. There was something called slippage, and it's whenever you say, I want to sell or buy at this certain price, and you don't get that price. Mm-hmm. It's filled at a different price. And he kept losing off of that. It was very frustrating to him. He couldn't understand it. Mm-hmm. So he lost all of his money. Well, he comes back and he bets on himself. He's like, I'm a smart guy. He's a mathematician. He
figured it out once. I'm sure I can do it again. Mm-hmm.
And he did it. Right. What did you say earlier about like the wealth that he amassed over this time?
So there was his most famous win was he predicted the 29 crash.
Oh my goodness.
And made, I think the estimate was he made $100 million in those days. That's dollars. Crazy. In like, it had to have been 2930, right around there.
It wasn't it was 2930, right?
And we looked it up. In today's dollars, that would be 1.8-ish billion dollars
on a trade
that he made on a trade. Several trades leading up to it because he saw.
But an instance mm-hmm. in time, mm-hmm. that's insane.
Yes.
But the thing I enjoy about his story is he is a trader. He was so calculated in what he was doing. But over the course of his life, mm-hmm. what he made and lost fortunes 4 different times. Mm-hmm. That is astronomical. What I am curious to think about is like he felt like he had a really good understanding of risk, mm-hmm. right? But you get to a certain point where all of the structures you put in place, all of the various things that you say, hey, I've got this mechanism, and if this triggers, then I do X mm-hmm. or I do Y. Mm-hmm. Obviously, at some point, those failed for him.
Yes.
Multiple times. One of the greatest traders to ever live.
And part of it, if you read the book, what kind of jumped out to me, or at least that's how I kind of read it, is he thought that because he was measured, because mm-hmm. he was thinking from a technical perspective, because he wasn't gambling, that he wasn't as susceptible to risk, which is part of the reason he lost his fortune 4 different times. Because, and I don't know that it was him being cocky or arrogant. I think it was just he thought that he could outsmart risk.
Yeah.
And there were times that he did. I think he more outsmarted price action, and he believed that he was outsmarting risk.
Yeah.
And it caused him to take way more risk than he should have, obviously, to lose a fortune 4 times.
Yeah.
Can you imagine that? Losing it once would be tough. Losing it twice, like 4 times.
It would be heart-wrenching. But what I got out of that is that we can feel like we're super calculated in the approach we take, do all of our homework.
Yes.
Trust that process, but not fully understand the risk that's still possible, right? There's that risk that I said before is that known risk. But there's always that unknown risk too. We talked about it before with Nassim Taleb, with
the Black Swan events.
Like there's always some sort of risk that can come out of left field and we have no idea about it.
That reminds me of some family history. So if you see these like gold framed black and whites behind me. So this is what I see. First thing, there's 4 of them. You can't see all of them, but the first thing I see when I walk into our office every day is these 4 pictures. And they are pictures of former businesses that people in my family, on both sides of my family, owned. And the first one that at the top left that I see was this drive-in gas station in Midland. And so there's this whole like family folklore around this thing. So the story goes that it was my great-grandparents were looking to move to Midland in 1923.
Prior to oil.
Well,
right?
If you know anything about the history of oil, 1923 is the year that Santa Rita #1 struck oil.
As we all know. Yes.
It was the first like major rig in Texas that completely opened up the Permian Basin. So this was like Midland before Midland was an oil town. But it's called Midland because it's smack dab between El Paso and Fort Worth. So they thought as cars were becoming a little more common in everyday life, they thought, hey, this might be a place to open up a gas station. So the family story goes that they wanted to open it on the certain corner that was right across the street from the courthouse. So they would sit at the courthouse and they would count the number of cars that drove by that intersection to see if there was enough traffic for it to make sense. That was
they're doing their homework.
That was their market research. And they decided, and they did not know about Santa Rita. And I don't know when like they opened it versus when Santa Rita happened or not. Yes, Santa Rita. I was like, Santa Ana, Santa Rita. totally different.
Not the Mexican general.
Totally different thing. Anyways, and so they opened this gas station and they happened to open it. They took the risk and they were rewarded partially for something that was totally out of left field. They could not have predicted that 1923 was going to start the Texas oil boom and Midland in the Permian Basin was going to be the center of that. So they were rewarded for that risk.
It's where hard work meets opportunity.
Exactly.
Right?
Which is great. And they ran it for years. I actually don't know how long. I would have to ask some family members. But then later on in life, and like decades later, they were dealt a blow because of risk that they were completely unaware of, could not control. They owned this like half block in downtown Midland, prime real estate that they owned. City of Midland came in and claimed eminent domain.
Oh.
And my great-grandparents got pennies on the dollar for this land.
Man.
And there was nothing they could do about it. So they experienced in very real time it was like a 40-year difference. But they saw the great side of risk and they took the leap.
The opportunity
came. And the downside that they couldn't even see, which was who would have predicted, oh, the city's going to come in and claim eminent domain on your land. And there's nothing you can do about it.
That's unfortunate.
Thanks, City of Midland.
And I'm sure many people have that same story where it's risks that could not be explained, could not have happened other than it just came out of nowhere.
Yeah.
And to change family fortunes like that too, down the line, both on the opportunity side and actually losing, right? Dramatically losing.
Yeah.
So I love that story because there is inherent risk to everything that we do. A lot of that risk is we take it because of the opportunity that's available to us.
Right.
Risk in the market, time in the market has produced many multimillionaires. Time in investing in businesses and doing other things like that has produced great success stories in that way. But a lot of people in the process also fail.
Yes.
Right?
Yeah.
That there is actual loss that comes from these things. And being blind to it, like purposely blind to it, doesn't make any sense at all.
Yeah. It doesn't. It's like when a kid covers their eyes and they're like, if you can't see me, I can't see you. It's like no.
Our daughter is right now. Yes.
Yes. Our 2-year-old doesn't quite get that
that
doesn't make her invisible. But it makes hide and seek really cute and fun.
And easy.
And very easy. But it's the same thing. It's like, oh, I can't see the risk. It must not be there.
Yeah. Ostrich sticking its head in the sand, right? So our goal is that whenever we see risk, whenever we talk about risk, we have a full understanding of the possibilities, both from a historical standpoint and just understanding how markets work, right? So looking at those two parallels and helping clients understand that for themselves, because everybody has a different feeling when it comes to risk. Some people, they're like, I don't care if it drops by 50%. That's when I'm buying. Other people, if it drops 10%, they start to have a little heartburn, right? And they're concerned. So our goal is, how do we get them on both sides to understand risk more fully?
Yeah. And what would you say to the person? Because some people kind of err on the side of like, well, I want to take the risk because you never know what proverbial oil boom is right around the corner, and I don't want to miss out on it.
Right.
Versus other people are like, but what about the eminent domain risk?
Yeah.
And it makes them maybe a little too risk averse,
and they miss out on
opportunity. And they miss out because one of the biggest things about investing and taking risk is persistence and resilience, and being able to stomach the down markets so that you can participate in the upstream.
Right.
Because if you try to time the market, you'll get, you'll get whipsawed. It'll be a buy high, sell low situation, which is the exact opposite. But in those situations, people could listen to us talking and hear that story and say like, well, then what's the point? Why even take the risk at all?
Well, that's very interesting, because a lot of times when we think about risk, we think of like losing, but we don't realize that there's opportunity cost too. So for the folks that I'm not going to do anything, I'm going to wrap myself in bubble wrap. I'm going to be in a cave somewhere and nothing's going to touch me.
That sounds awful. I don't want to be in a cave.
In bubble wrap? No. Okay. But the folks that are so concerned that they're like, I'm just going to stuff money under my couch cushions. I'm going to have gold bullion buried in my backyard.
Ron Swanson style.
It wasn't my client, but there was somebody I knew that had a treasure map. They had a ranch and they had a treasure map, and they had, I think it was 4 different spots on the property.
No, they did not.
That they buried water, food, like imperishable type food, and gold, and guns and bullets. Yep.
So they were like doomsday prepper gold bugs.
Pseudo. Yes. I'm like, I think you have to worry about folks watching you dig up something in your yard if we're at that level of apocalyptic ending. But what I always think about is the opportunity cost, because for folks that decide not to do anything, I'm going to stuff cash under my mattress. you are losing by not participating.
Mhm.
Like, that's something I try to get to the folks that are so risk averse, is like, if you don't participate, you are taking more risk than you realize.
Mhm.
And you will outlive your money, or you will have like, you won't have the life that you want in retirement.
Mhm.
Like, those are things that matter to these people, and to get them over the hump of like, not taking risk is also risky.
Yes, which is really counterintuitive to people.
Mm-hmm.
But that's I like
So
that
that's
a lot.
one side of it. How about for the very risk on person? I'm 100% Bitcoin and Ethereum and whatever new crypto comes out. What are your thoughts?
I love that you said crypto, because I have so many feelings and
That's
thoughts
why I
around
said
crypto.
it. I just want the
You're gonna
audience to
make
get that feel.
you're gonna make me bite my tongue here. Don't want to get in trouble with all the crypto bros out there. Even though it funds illegal activity, it's fine.
So does cash, but
we're not having. It is not the same thing.
Well, no, let's just talk about risk.
Okay, risk. Back.
Yep. Back
Squirrel.
to risk.
Okay. I think there are two different archetypes with that.
Okay.
One is people who overestimate their ability to stomach that.
Mm-hmm.
We have seen both just friends and, just stories we've seen, and with some clients who say, I want 100% all in single stock picks.
Yeah.
Large cap tech, give me the Qs, give me nothing else, or just put me in the Mag 7. It's gonna keep going. And then when there's even little tremors, they're freaking out.
Mm-hmm. Apple stock goes down 10%.
Yes, and they're concerned,
mm-hmm.
which means that the risk that you think you can handle versus your reaction right now shows that there's a disconnect.
Yeah.
So I think that's more of a misunderstanding of risk. But for the people who are, and they're kind of anomalies.
Mm-hmm.
Like, most people cannot stomach that level, that really high level of risk,
Mm-hmm.
where if the market's down 50%, your portfolio is down 50%.
Or
maybe more, depending on
if
if
you have more beta. It's,
if you have zero fixed income exposure, I mean, anything. For those people, I think it's just a matter of capitalizing on your ability to stomach that risk, which is what you mentioned earlier, is if the market's down, those people are the first ones that are like, let's buy.
Mm-hmm. Yeah, let's do it now.
Mm-hmm. It's one of those extreme cases of you can handle the downturns because you're confident that the recovery is coming.
Mm-hmm.
That's really where it comes down to.
Yeah.
People who are confident that the recovery is coming are far less phased when corrections and recessions and downturns happen.
Yeah.
The people who, like our Reddit friend who said, this is over, sell everything. If they actually sold
that last line of the mercy,
goodbye, and may whatever comes next be merciful. Sell, don't look back. Like, I don't know if this was just someone,
having a little fun,
or just like trying to let off steam through a Reddit post.
Mm-hmm.
But if they sold on May 4th, or not May 4th, April 4th, they would have been kicking themselves on the 9th.
Mm-hmm. Well, and what I find to be true, even like personally how I felt before, if I've sold a position, I'm waiting for that next drop to happen. And you wait and you wait and you wait. And all of a sudden, it doesn't come like you're expecting it to.
Yeah.
That's a real issue with investing, is you think you can time something. You think you have an understanding, and all of a sudden it switches on you. So there were a million different indicators in 2022 and 2023 that a recession was coming.
Yes.
Right. And lots of economists, basically everybody's saying it's impossible for us not to go into a recession. And we didn't. Some of that has to do with trillions of dollars flowing into the system from the government.
Mm-hmm.
That's part of it. But it helped us avoid a recession.
It pumped up inflation significantly.
Pumped up inflation, kicked the can down the road.
Mm-hmm.
We don't know exactly what's going to unfold over the next 5, 10, 30 years.
No.
But what we do know is that risk and return are hand in hand.
Mm-hmm.
And if you want to have growth in your underlying assets, you want to experience that level of success as, in just money terms, you have to take risk.
Yeah. Yeah. And I think it's interesting because for us, like, one of the things you have to figure out if you are married, or if you have a domestic partner.
I have no idea where this is going.
Well, we have different risk tolerances.
Tolerances,
like, you, by and large, you are more risk averse than I am.
I tend to be, yes.
Tend to be, generally. But I have a harder time stomaching the downturns than I think you do.
Mm-hmm.
Like in our day-to-day, like, kind of spending and money management, you're the one who's more conservative.
Mm-hmm.
I'm the one, when we were down almost 20% mid-April.
Yeah.
I mean, I'm a finance professional, and so I know all of the right answers. I knew eventually what was going to come. We couldn't have told you timing or anything.
Right.
We just knew it could change on a dime, and it did.
Mm-hmm.
But I still hated that feeling of looking at our account and being like, oh, that doesn't feel good.
Yeah.
But
well, you're person, like, you have that gut feeling, you understand risk better than most people. I mean, you worked in a shop that made money off of risk, right? Like the risk in the market, off of volatility.
Yeah.
That was where you worked prior at a hedge fund. It was all about that.
Yeah.
So you understand risk, but then you still have that gut reaction.
Yeah.
Like it's that know thyself.
Yeah.
Right?
We've talked about that a few times with different things. Know your history with money. Know your emotional attachment to money.
Yeah.
Know your risk tolerance. And once again, it's far more about your reactions and your opinions than it is about some number on a page.
So what you're saying is we should all create our own Reddit posts and write down how we feel in different market cycles. So
yes,
when the market goes up 10% in a day, write a Reddit post. When it goes down 8% in a day, write a Reddit post.
I'd say maybe not publish it. Maybe just
probably not a good idea. It might be in one of our future videos. Yeah.
Yeah. Maybe it's one of those things like, just because you can post something doesn't necessarily mean you should.
Right. Yeah. Well, practically, I feel like we've gained a lot of traction here. Is just knowing your own thoughts. How do you interact with risk on a daily basis? How do you mitigate risk? How do you absorb the risk? How do you try to pass it on to somebody else? Right. Those are all pieces of risk. So understanding yourself, and it's really great, honestly, to have market corrections. People don't think of it as great, right? It doesn't feel great, but it is good because it gives you a chance to recalibrate your own feelings toward risk, to actually in real time be like, I didn't like that, but I'm okay with it, right? I can go through this dip, or I didn't like that, I want to sell right now. At least understanding that aspect of it.
Because it's two different things. No one is I don't think anybody, regardless of if you are the most risk tolerant person in the world, nobody likes pulling up their Schwab statement or their Fidelity statement or whatever and seeing their account in the red, in significant red. We hate loss. There's been psychologists have talked about this ad nauseum. Like, we hate to lose. Yeah. And that's just human nature. And so there's a difference between, like, I really did not like it. It was hard to stomach, but there's a difference between feeling that and not liking it and having taken on too much risk to the point that you are acting on it.
You capitulate.
Exactly.
Yeah.
Exactly. And we see
Just
it
like that person.
Yeah. And you see it in every cycle.
Mm-hmm.
It happened in 2008. It happened during COVID. It
Yeah.
happened during the .com crash. People get so scared. And this is not the first person who, when a down market happened, they freaked out, thought there's no possible way for a recovery,
right,
and pulled at the worst possible time.
Mm-hmm.
Because if, it's a perfect example. If you had pulled during the worst of the downturn, you would have missed out on a historic bull run
Yeah.
that came after.
Yeah. Well, I
And
think
people did.
Exactly. One of my favorite diagrams I look at almost quarterly. It's a JP Morgan Guide to the Markets, and it's consumer confidence versus 12-month following return. So a year later, what has happened. And usually when consumer confidence is way low, the following year is a monster up year. It's just almost always that way. We'll put that in the show notes too, but it's one of my favorite charts because it reminds me, even when I feel fear, like that's usually the time, when blood is in the streets, you want to invest. That's when you want to put money in. So it just gives me the right perspective that even though I feel a certain way, my action should be the opposite.
Yeah.
Most of the time. That's how I should operate in that capacity.
And it kind of shows, like, generally speaking, our guts when it comes to market activity aren't great.
No, it's very good at telling me when I'm hungry, but when it comes to decisions and what to invest in or when to invest, it's not very good at it.
Okay, so eat a sandwich, but don't make trading decisions off of fear.
Probably wait till you finish eating the sandwich too.
Yeah. See, maybe you were just hungry.
It's possible.
This is great. I think it's helpful for people to know. And I think, kind of going back to it, our very first episode, just as we wrap up, thinking about the fact that I wish we could normalize. The whole reason we wanted to start this, normalizing having these conversations. Finding people, whether it be an advisor or a trusted friend, who has some basic financial literacy is important. But having some sort of outlet to be able to talk about this.
Yes.
To just be able, like, we're designed to process things together as people. We're social creatures. And so being able to just be honest about, like, hey, what was it? I wrote it down. From February 18th to April 7th, market was down almost 19%. That April 7th, I'm sure a lot of people would have liked to have some sort of outlet, conversation to say, like, man, this is tough. This is hard to weather.
Yeah.
And I feel okay about XYZ. I don't like XYZ. I think this one's a little harder since it's more, we're in a very politically charged environment, and that obviously has implications for the market. But I wish we could normalize that.
Yeah.
And so,
well, it helps people make better decisions.
It does help people make better decisions. And sometimes it's just like, oh, you hate this. You have a, like, kind of a stomachache about it. I have a stomachache about it. Okay, I'm not alone. I'm not crazy.
Yeah.
But also not going into, like, Reddit forums or any other social media that's just like an echo chamber or very hyperbolic. Yeah. So I think people can lead out in maybe fostering conversations, and some of it is like leading out in vulnerability to be the first to talk about it.
Yeah.
So that when the next downturn happens, like, among those people that you trust, you can open up the conversation a little easier every single time.
Absolutely.
And if not, you should find a trusted advisor who can help you talk through those things, and help you from an objective perspective, think through what your risk is. And if
we do it every day.
Yeah, we do it every day.
Yeah. Well, we appreciate you joining us to talk about money, or risk and money.
Risk and money.
Risk and money. Next time, what are we talking about next time?
Next time, we are going to talk about time. Time and money.
So elusive.
So elusive.
Many people equate the two. I'm excited to talk about it.
Yeah. All right. Well, we'll see y'all next time. Hope you have a great week.
Bye.
Bye,